All right, good morning, everybody. I hope y'all had a good weekend because we're back at it to do it again this week. We don't have a lot on the economic calendar. Everything is focused on the war and crude prices. We want to keep our eye on volatility, not just equity volatility. There is uh, volatility for commodities. You can specifically target crude volatility, gold volatility, that sort of thing. You've also got uh, FX currencies volatility. So when we think about volatility, try to expand your horizons a little bit and look beyond just the generic equity volatility like VIX. Lots of talk this morning about the SPR, the Strategic Petroleum Reserve. When we're not in war, that is oftentimes used as a collar around price and a way for various administrations to ease pain at the pump. But what it was designed for is the ability to still have energy even if the global supply gets bottlenecked and shut down, like in the Strait of Hormuz. One of the problems with the Strategic Petroleum Reserve is that they fluctuate it, right? They fill it up and then they use it for political purposes and they kind of empty it out and then it needs to be filled back up again. Well, it wasn't at capacity. And so now when they need it, it's coming in a little bit short. Now, they've already made comments about they're not going to ease the pain at the pump anymore because of the war situation. And instead, they are actually going to use it for what it was designed for should the need arise. So that means we're going to see more domestic price going up. And of course, the ignorance of America, everybody with their head in the sand, acting like they just don't care about anything except what the Kardashians are doing. It's going to be a little harder to ignore things when the price is staring you at the face and you got to pay to play. So we'll see. This is just going to make the situation even more volatile and rock and roll, right? We'll see where it goes. So keep your eye on any statements, headlines on the SPR, the Strategic Petroleum Reserve, and the Strait, whether or not, the bottleneck gets worse. There, the national average, I don't know if we want to say it that way. Typically, the strategic reserve holds around 700 million barrels, and right now they're sitting at about 400 million. So, it's better than half. It's just not filled up all the way, right? That's kind of where they're at. And so when you have, where was it? Kevin Hassett chipping his teeth about the SPR and how they're not going to do any release anytime soon, that's a signal towards the pumps, right? The gas prices and energy costs in the U.S. They're not going to run any political theater to knock those prices back because they just can't spare any right now. The screen that we're looking at is net gamma. SPX reference price 67.44. This is 6700, this really big bar where I have my mouse. And this is 6750. So we're in between those two. even if we can get through 6750 and make a run for 6800, that's still a really large bar. That's the last hurdle to get through before we continue to push and we get on this side of things. And then we've got 7,000 up here. It's a really big bar. We've got OPEX coming, so it's hard to see how we're going to be able to get through those rails. What would be more likely is that as we get into OPEX, those rails get shifted, right? They roll into another position somewhere. So to the downside, we do have this large structure. We can slowly eat away at that, and or it can be rolled and moved as a part of the OPEX repositioning. But it's one of the things that we want to keep our eye on is what kind of structure do we have underneath us? It kind of thins out into 6650, then builds back up at 6600, and then again 5550 and 6500. 55. We ain't going there. All right, so we do got levels below us, structures that we would need to work through. Just want to keep our eye on those big levels to see if they're rolling out, if they're repositioning, building up, and of course, keep our eye on the clock. So red around the world, it's not really a surprise. Japan turning things around up 0.5%, but everything else still red. We had new names added to the S&P, announced Friday. So VRT was one, Light was another one, LITE, Coherent Corp, COHR, and EchoStar, SATS. Those were all added. They will go into effect on March 23rd. And the names that are getting removed, MTCH, MOH, LW, and Paycom Software, PAYC. Of course, names that get added to the S&P generally get a bump just because, there's a lot of ETFs out there and different funds that need to hold each part of the index to develop their balances. So they're kind of forced to buy it whether they like it or not. S&P, NASDAQ, and Dow are down around 1%. Small caps taking it just a little further at 1.8%. Keep your eye on small caps this morning. If we want to see everything flip over and maybe make a run to the upside, it's possible we'll see the tail on the small caps first. We do have some auctions today, but they're all in the front end, 3-month, 6-month. You could probably just use the IRX, keep track of them that way. These are not the big ones that we generally focus on. Those are 1 o'clock auctions. These are just 11:30 auctions. Now, don't get me wrong. I would never advocate that we turn our back on information or ignore a data print that could very well run us over. Just historically speaking, these aren't the ones that cause us drama, right? These are not the droids you're looking for. So they're probably not going to cause us any issues. Just keep in mind we do have auctions today. The score out of the White House is 35. It's a little high, but I mean it's still a really low number, all things considered. They call it moderate. 100 would be extreme, 0 would be nothing. So, 35, well below the midpoint. Some of the biggest risks is whether or not the president is going to be making remarks, whether there's going to be Q&A, right? That's where we really start to get the risk. And September, October is still where the market is pricing in a curve for a change in the rates. So we're not looking at the market repricing anything with FOMC and rate cuts. Not at the moment. All right, we did gap down into the 200-day moving average, crossed underneath it, came back up above it. Now we're back down underneath it again. It's a major level, and it can act a little bit like gravity or like a magnet. So we're there. We want to kind of keep our eye on it, and it's worth considering reciprocation. It doesn't quite fit here, but it's worth the logic of it, right? This is how far we went underneath the 200. It's very likely that we can now go above it for the same amount, and this can become a zone that we sit in and develop out like a collar. We don't have that yet, so it's something that we want to look towards and consider that. There's also the gap that needs to be filled. I think it's a pretty obvious gap, right? With the futures, you have two kinds of gap. You have the gap from one day to the next when the market closes at 5 and opens back up at 6. That 1 hour gap is its own gap. Then there's where we closed at 5 versus where we open at 9:30 in the broader market the next day. So two different kinds of gaps that we get in the futures. Right now, the gap that we're focused on is the one from Friday night to Sunday night. So this is what we've got to get back to. 67.40. It's an old school cog line we don't use anymore, but 40 should always be on your radar. We got to get back up there to get the gap closed. Then we got to see where we open at 9:30 because that'll be a different definition, but it's still something that we got to focus on. Overnight volume plus 200, running at 266. The average is around 55 or so. So we've certainly got market participation last night. We've already retraced since where we opened. So we're basically back to where we started last night. Now we just got to get back to Friday's level. Even with reciprocation around the 200, we can get that gap closed. How much more we can get after the gap closes, that's kind of the issue. And it's not really a surprise that we jumped the put wall. 65.32 cog line is the low from last year in November. So right now we want to focus on that. That'll take us down into the 50 week, 65.32. Now it doesn't owe us that, but it's an obvious target if we continue the fade. 65.32 with an overshoot into 6,500. All right, looking at the ADR, we've already hit the ADR. The common market logic is if we get to one side early enough in the day, we can get to the other side by the end of the day. If you look at the ADR half on the upside, it's basically that gap close that we were talking about. So we want to continue to focus on getting that gap closed, 67.40-ish. The market open bar from last night can be used for your evaluation tool. You can snap that for 111 and 1236. You can also get your midpoint off of that. So at this point, we need to hold above the ADR on the low end. Now that we've come down there and we've left that range, we don't want to go back. It's not a good thing to go back there. It's less likely to hold if we revisit it. Then we'd be looking at a breakdown and a continuation to the downside. There's no market maker move this morning, so they're not coming in running any additional hedges, and that kind of makes sense. The barn door was already open, everything got out. Closing it now would be a bit late. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it. That's also bearish. So far, we haven't hit it. So we have an MDP, missed daily pivot. It doesn't count today. However, it won't count until tomorrow. We have to go all day without hitting that line. That's 67.70. To even get there, we would need to break back inside of Friday's range, get that gap closed, and then come up and get into the floor pivot. Doesn't seem like we're headed in that direction. We are firmly underneath the weekly pivot, but we haven't traveled far enough underneath there to be looking for some sort of mean reversion. That's only a 3% move. I say only, but it was a 3% move below the weekly pivot in a single day. So it was a bit much. But we've already retraced a lot of it. So, that takes a lot of the weight off. And since we now have done that, we can go back there and it won't have the same level of stress that it had before. We would need to go deeper than that to start seeing new stressors. So now that we've done that, we can easily do that again. It's very likely we would have to get below 65.50 before we start to see new stressors. Because of the narrower range we had on Friday, although it doesn't really feel that narrow, this is the SNR levels we've got for today. We've been below S2. That opens up R2 way up here. Of course, that would be an inside day breakout to the upside. which would be we would need such a significant push, right? First, to get back inside of Friday's levels, get the gap closed, get through the mid, all the way through yesterday's high, out the top, and then expand even farther than that to hit R2. Now, don't get me wrong, price can do whatever it wants. We know that. So it is possible to do. But what would be the fuel that fires such a significant run like that? It'd have to be one heck of a headline. We don't have anything on the economic calendar today other than some very small auctions and a little bit out of the White House. So, other than some gotcha headline that we can't see coming at the moment, there's no fuel to provide that sort of lift yet. So that's something to keep your eye on through the morning, is something that could provide that lift. It is worth noting, by the way, that gapping down on a Monday to start the week is inherently more bullish than bearish, right? The typical outcome on a gap down Monday is long, not short. So, if you're new to all of this and you're wallowing in despair, well, tread lightly, because this is a typical reversal setup. Now, that does not mean we're going to go up, right? It is worth repeating that. It does not mean we're going to go up. I'm not running some sort of crystal ball that tells the future. But historically, this signal is really common. Get a deep gap down on Monday and then a solid reversal off of that gap down. So we got to let it play out. Just be mindful that it's a two-way street at this point. They are not in here just hammering everything negative to the downside and washing it all out. Last week's distribution at this point doesn't have much to offer. We're completely outside of the value area, the point of control, everything. So looking at what we've developed this morning, we got nothing, right? Not a lot to it at all. It's just this little speed bump. So we need to build things out at this point. Ten-day, 30-minute volume profile in TPO. We got a nice expansion to the downside. And through the week, this week, we're going to chop the top of this off. Should lose everything above 6,900 by Friday, which will tighten up the range a little bit. Right? It'll look more like that. So we've got around 320-ish, maybe 350 possibly. That'll tighten the range up some, but all things considered, that's still a pretty wide range. We left everything behind. If we get that gap filled, it's possible for us to get back inside the value area. And then, of course, target 6,900 for the point of control on the 10-day. But start with getting the gap closed. So far, just getting out of the box that we've created down here seems to be the bigger trouble. We've got to get out of this box and then get that gap closed and then get into this box. One trouble piece at a time, right? We've got a new VPOC from Friday. So if we can get this gap closed, then we want to target Friday's point of control. Now, I'm not going to zoom in on that and try to get it, to the tick perfect. You do you. I'm just getting it close enough. They put in a lot of defense, front running that 66.90, but it thins out across the highs here, right? So like buyers got exhausted as we ran up into that breakout of the open bar, 66.92 cog line, nice and thin. So exhausted buyers, that's different than getting hammered down by a bunch of sellers. See if we make another run against that high and what sort of behavior we get out of it. All right, on Friday, we examined the new week's range, but at the time, it wasn't locked in place yet. It was still alive, it was moving around, and the idea was that we were going to need to come back and examine it on Monday to see what we finally ended up with. Remember, this is a tell on volatility as long as the time on both weeks is the same. If last week is a 5-day week and this week is a 5-day week, then they have the same amount of time. The only difference left is the difference in volatility. And you can see the week that we have now has a much wider range than the week that we had last week. Generically speaking, economic calendar does not make this get wider. So if we had CPI, PPI, non-farm payrolls, FOMC, those sorts of things would not give us a wide range because those are volatility suppressing events. They give us a narrow week range in what I call a hurry up and wait scenario. And that's not this, right? We've got a really big range projected here. These projections are based on trades that were put on in the options market that expire this coming Friday. That's where the formula is focused. So the market is anticipating big moves this week. That doesn't mean we're going to get them, but that's what they're trading into, is the expectation of these big moves. So the market sees volatility this week, and it won't be volatility from the economic calendar. It's going to be from something else. That's where we have to go in and kind of play detective and figure out what's the market perceiving as a threat that gives them the confidence to price in this wide of a range. Very likely more war stuff, right? We're 2.5% below the 10 week. If we look back, we've certainly been deeper than that before. This is generally the point where if we was going to turn around, we would have already done it, right? Usually that happens around 1.8, 2.0, and we're at 2.4. So we're kind of past the early turnaround point. Now we're looking at something deeper. 4.5, 6, 8, 12. It gets a lot deeper from here. Now, of course, it doesn't have to do that. We can still turn around. There's, examples here where we only went 3% and then we turned, or here 4.5 and then we turned. Multiple times we turned at 4.5. So keep an eye on how far below the 10 week we are getting in the anticipation of a reversal and a move back the other way. Notice the violence on the move back the other way. A lot of times we retrace the whole move and get back above the 10 in a single shot. So we might be down 4.5% one day and be above the 10 by 1% the next day. That's one heck of a move. Looking at the distance on the 10-day versus the 10-week, 2%. So we're 2% below the 10-day. We were looking at the 10-week. This is right around that reversal spot, 2% on the 10-day. It can get deeper from here, but usually that ties in with a story a narrative that sticks, that lasts for a while, like back when the president first started talking about tariffs. He introduced them in the new year, and then, it just got worse and worse into April before the bonds got him to flip. So that was a story or a narrative that just kept getting worse and worse, and we just kept sinking and sinking and sinking until we finally flipped it all over. That's different than just getting some price action that drops us below the 10 for a brief period of time, and then we're back up through the level and making moves to the upside. We haven't had a narrative that's kept us below the 10 like that for a while, right? Looking back, it was back here. And this was during the whole market pricing in, unwinding, potential rate cuts, right? That was pretty violent last year in the fall. We haven't had anything like that since then. So if this narrative sticks around, we could keep this distance below the 10. But other than that, without a story, a continued story that stays negative, it's hard to see how we can maintain this level. We're going to end up buoying back up the other direction. Remember, markets want to go up. So if they're going to stay down like this for the indexes, it's going to take a continued pressure to the downside. The analogy that I've used in the past is take a rubber ball and put it in the water. Instinctively, it floats. You have to hold it down. If you don't hold it down, it just pops to the surface. That's the indexes. If you don't hold them down, they just go up. So it's going to take a sustained pressure to the downside, or else it just pops right back up again. All right, looking at what's down this morning, it's a really long list. It might just be easier to look at what's not down this morning and or what isn't moving. So the IPO is basically flat IYT. Otherwise, China's up, XLE Energy, XOP Energy, Nat Gas, VIX, bond volatility. Everything else is basically negative. That's not a surprise, right? Like everything's down this morning. And that's what we would expect. So we've got a really simple morning. Get out of this box, and that gives you your bias and your direction. Break the mid to challenge the low. Then we'll aim for 65.50 and 6500. Stay above the mid to re-challenge the high of the Globex. Break yesterday's low. Get to the gap close. Challenge the RTH mid of Friday, and then the full mid of Friday, and then Friday's high. Easy enough, right? So there's the midpoint of Friday, which, looking at that, is really close to the Friday close, the gap close. So we'll just focus on getting that gap closed, and then we've got all of Friday. With the midpoint at 83. So that's simple enough. So those are the levels to the upside. We've got the levels to the downside. All we got to do is get out of this box. It's a pretty good gift, all things considered. I mean, you couldn't ask for much more than this. Since we're so negative this morning, if we do start to turn around and make moves to the upside, it should be easy to spot where the positive fuel is coming from. 0-day flows, dollar movement, precious metals, commodities, treasuries, FX markets, whatever's giving us that bump, it should be really easy to find. So then we can just track whatever that is to see if we're going to keep it or not. And of course, keep your eye on the VIX. We need that to back off if we're going to make any run to the upside. So, yeah, take what we can get, right? Everybody, be careful, be safe. Have a good day. I'll see you all tomorrow.